Today we're going to be taking a look at the Roth Projection Tool inside Holistiplan. Let's go ahead and get started. We're in a household for Bob and Jane Roth. Bob and Jane Roth, an allusion to Bob Ross. We're going to paint some happy little happy little Roth conversions here, and just show you what the power of periodic Roth conversions do for your client. Here we have Bob and Jane Roth. Bob is 62, Jane is 60. If we go over here on the tax Roth projection side, we can see the Roth Projection Tool. We've already created one here called the Joy of Rothing. If you want to create a new one, you just hit this bubble here. You click the three dots, we can copy this over if you've already created one and you want to take a look at maybe making a few changes. So we're going to go right into the Joy of Rothing one here and just kind of see what we've done, doing a quick overview of some of these values. So as I come in here, you're going to see the Roth Projection Tool, the Joy of Rothing. And I'm going to get rid of some Roth here. Just to note, you can click on any of these labels here on the graph and it will show you, or it will show or hide different sections of the graph depending on what you want to show your client. So here we have the graphs on the right hand panel. On the left hand side we have the control panel. Here are all the different graphs you have as an option. You can input by age or by year. We can look at nominal dollars or today's dollars and present value. We have a warning section. I'll talk a little bit about more of that now. A little bit more about that later, rather. We have some general assumptions. We're going to kind of go through what those look like. We're going to assume a 6% rate of return for Bob and Jane, who are in their 60s. We're going to assume that 50% of these gains are attributable to growth. What that means is that those gains, that 3% of this rate of return here, you can see 3% growth, 3% income. 3% growth, that means it's going to remain in the portfolio. It's going to continue to grow. It's going to continue to grow in anticipation of being taken out later as a long-term capital gain in the future. So these, we're talking about the percent of returns attributable to growth. That particularly is important with the taxable assets, taxable non-qualified assets in the portfolio. The biggest or the best proxy we've seen advisors use for this, think of this as the percentage of equity exposure that your portfolio has as a whole. If your client's in an 80-20 portfolio, meaning 80% equity, 20% fixed income, you would put it in 80 here. So the higher this percentage, the more tax efficient the portfolio. We're going to assume a tax liability, something under 24%. Essentially, they're tax deferred assets. They don't have 100% of them available to spend, right? Uncle Sam is the joint owner, and he always gets his. So instead of having 100% of that tax deferred balance available, we want to assume that there's a 24% tax liability. For the nerds in the room, me included, what this number should ideally be, if you wanted to be precise, this is going to be the weighted average effective tax bracket over time. That's hard to predict. We're just going to assume 24% for them because that's about where they end up landing here. We can see that the 22% bracket starts at this green line. The 24% bracket starts here at the yellow line. So if we don't do these Roth conversions, we're just going to say they're in about a 24% effective tax rate in the future. So that's why we picked 24 there. Have a 2% inflation assumption. Here we have the Roth projection name, which we gave when we built it. Happy little Roth conversions. You can put this title any way you'd like. It's going to show up here underneath the bottom. For our clients, this is what we did when we created the Roth projection. They're married filing jointly. We're starting this projection in 2025. Taxpayer 1 and client 1 is Bob. Taxpayer 2 or client 2 is Jane. We're going to pull their dates of birth from the Holistiplan client household, and that's how we know what standard deduction to apply in the analysis. And if they're 65 or older, we're going to apply that senior deduction as well. Okay, they're neither one of them are blind. If they did, we would check that box. They would get the additional standard deduction factored in. Their assets, we say they had $250,000 of taxable assets. What are taxable assets? Those are anything that aren't retirement accounts. So bank accounts, checking, savings, money market funds, anything that's held in a taxable account, you want to make sure you put it in this box. For a cost basis, that's important later on. When we start making distributions out of the portfolio, that's going to tell us how much of a net gain is coming out and how much is exposed to long-term capital gains taxes when it comes out. $500,000 for each of them in their tax-deferred assets. It can be a rollover IRA, a traditional IRA, 401k, anything that has pre-tax dollars in it, and it is the target for a Roth conversion. So $500,000 for each of them there. $250,000 of joint Roth assets. We're going to assume that Bob lives to age 100. We're going to assume that he has beginning at age 62, which is the first year of this analysis. Remember, he's 62 now. We're going to start the analysis in 2025. So we're going to show him with $150,000 of wage income beginning this year for 2 years, right? For 2025 and 2026, it's going to inflate by 2%. In 2027, we want that to drop to zero. It's very important if you want a cash flow to end that we put a $0 amount here. So we have $150,000 of wage income for Bob for 2 years. We then have Social Security income of $30,000. We're going to begin it at age 70 for Bob, and we're going to inflate it at a 2% clip per year. Then move for client 2, we have Jane. She's going to have a life expectancy of age 100. We're not going to have any wages for her because we're going to assume she's already retired. She's receiving Social Security also like Bob at age 70 at a lower amount, $25,000 inflated at 2%, going on forever. You'll see this bump here. That's because she begins taking Bob's amount, which is a higher amount. Remember the rules of Social Security. You can take either your record or your spouse's record, whichever is highest. Bob passes away. He's 2 years younger than her. So at age 98 for Jane, he's age 100. He's passed away. So she begins receiving that higher amount. That's why you see that bump here for Jane. She also has a pension. She's receiving $24,000 a year. She began it at age 60, inflating at 2% and a 50% survivorship benefit on that pension. Then for spending, we have them spending $72,000 a year, beginning with this year, 2025. We're inflating that at 2% a year. If you have a client that's going to have some spending lumps, you can program those in as well. But here we're just going pretty vanilla. They're going to have a $72,000 annual amount of expenses for the rest of their life, beginning in 2025, inflated at 2%. For cash flow, excess cash flow, if what Holistiplan is going to do is we're going to look at the income that's in the scenario. In this case, we have wages, Social Security, and pension. You could have annuity income. You could have wage income. All of those types of income. We're going to compare that income with the expenses, and to the extent the income doesn't meet the expenses, meet the need for the spending, we're going to start pulling out of the portfolio. So what we're saying here with this assumption with excess cash flow options, we can either reinvest that surplus back into the taxable assets pot, or we can spend it all. It's up to you which one you want to do there. For Medicare assumptions, we will show the impact on IRMAA across the scenarios. In this case, we're going to have them beginning Medicare Part B at age 65. If he's employed and is still working, he can be on the employer plan. So, but we're going to have him receiving those benefits at the customary age of 65. Medicare Part D premium, we're going to have them having a $600 annual Medicare Part D premium. Part D premiums vary by zip code and by the plan you select. So we don't really have a way to calculate that because it is a little bit more customized. We're going to have Jane receiving her Medicare at age 65 as well, also a $600 Medicare Part D premium. We're going to apply and save. They also have QCDs. We're going to assume that Jane's IRA, we're going to have QCDs starting from her IRA of $5,000 beginning at her age 71. If we put in an age that's ineligible for those QCDs, we will warn you about that. So we're going to say that they have to be 71 by the end of the year before we'll allow you to put that in. So we're going to put age 71 here. She'll be 70.5 early in the year, but she's going to do $5,000 of QCDs starting at Jane's age 71 all the way to end of life. So we have those in there now. So what we like to see advisors do, what they tend to do with their clients, we're going to click on all these labels. You can click on all of these and they will either be hidden or show. But I'm going to get rid of the Roth scenario that we've done for them. Here we see a classic case. This is probably the most common sweet spot we see for clients that financial planners like to look at Roth conversions. Remember, we have Bob working for 2 more years. After he retires, we have a lot of space here. We have a lot of low income years. Age 70, that's when Bob's Social Security starts. Age 72 for Bob is when age 70 is for Jane, and that's when she starts collecting her Social Security. But then at age 75 for Bob, remember if you're born in 1960s or older, your RMD started at age 75. So Bob starts his at 75. Jane is 2 years older. Hers kicks in at Bob's age 77. So then we have this ticking time bomb here, right, of all these RMDs growing. And what we're trying to do is fill up some of these lower income years here with Roth conversion income to try to smooth out that overall tax bill. So what I'm going to do is I'm going to, advisors would like to show that picture and then project out some Roth conversions. Now, how do we decide on how much Roth conversions to do? You can see we've entered them here in the Roth conversion section. Again, we put some zeros in here because we want to end Roth conversions on those years. But in the years where the bar graphs are equal, you can see these two are equal. That's because the ordinary or the base case is the same as the Roth case because no Roth conversions are happening. As we go over time, base case has tax bill of 0, but we're creating $91,000 of income and at age 64 for Bob, for example. We're trying to fill up this 12% bracket. The 12% bracket ends at 102,800, which is where the 22% bracket begins. So we're trying to fill that up, and we do a pretty good job of it here at pretty much throughout their RMD earning years. So what does this do for them tax-wise? Well, it's going to save them $850,000 in taxes. You can see their tax bill is smoothed out greatly over time. Those RMDs kick in, they pay no taxes here in these lean years, right, after they quit working. But that's more than offset by the tax bills that are generated here when these RMDs start kicking in. So we've saved them $850,000 in taxes. We've saved them $33,000 in IRMAA surcharges that would otherwise have kicked in when those RMDs pile up. Portfolio value, they're ending up with over $1 million more in their portfolio. You can see that here. And then as we go to portfolio values by asset type, these are really helpful for clients that have a legacy wish, right? So if we don't do these Roth conversions, everything continues to grow. They have a $10.1 million portfolio. Almost $2.5 million of it is in Roth assets from that $250,000 they had to start with. They have $1 million in tax deferred assets. If they have one beneficiary, that one beneficiary is going to have to take out about $1,100 a year, or excuse me, $110,000 a year, roughly, to spread that out over the 10 years under the Secure 2.0. So I don't know, maybe they have a beneficiary that's a high income tax bracket, maybe that's not ideal. So what we do is when we look at the Roth case, when they do these periodic Roth conversions, instead of handing their beneficiary a portfolio, they hand them, first of all, they hand them one that's $1 million higher. And of that $1 million more in the portfolio, we can see that $10.5 million is tax-free, is in a Roth account. It can continue to grow for 10 more years in that tax-free environment before it's ultimately distributed out at the end of the 10th year. No tax deferred assets, so they're not subject to any taxable income coming into their tax picture, right? And they have $626,000 of taxable assets to get a step up in basis. So a lot more favorable picture for the heirs here in that Roth case. RMDs, we can see that they've chipped those down tremendously, and their RMDs are virtually nothing by the time we reach the end of the plan. So really what the Roth Projection Tool allows you to do is look at the long-term implications of a multi-year Roth conversion strategy. And we think it's really helpful to just paint a picture for your client of really the value of what multi-year Roth conversions can do for them, and ultimately prove your value to them as a financial planner. Really tremendous stuff. We hope you enjoy it, and hope to see you another time with the Holistiplan. Thanks for joining us today. Bye-bye.